We've been chatting a lot about the South African market this morning.
Good morning.
How about the African markets and some of the interest that we're seeing from South African investors moving into the continent? Is that growing?
Yes, it's going well. Good morning, Stephen. What a story Africa is. If you look at the IMF growth forecasts, till 2015, 7 of the top 10 fastest growing economies are expected to come from Africa, so that's positive. And then an Ernst & Young survey expects foreign direct investments of 150 billion to 2015. South African fund managers have acknowledged this phenomenon, and we have seen a lot of interest from the debt side, credit side and equity side on the South African fund management side. If we look at your dedicated cash-only long South African fund managers who manage funds in Africa, we estimate that the top 5 manage about $1 billion worth of assets. If you look on the unlisted side, the private equity infrastructure and development side, over the last 10 years, the top largest funds raised in terms of capital, $4 billion was raised amongst the top 4 South African funds. So they have acknowledged this phenomenon, like I said, and they are taking direct measures to invest in Africa. However, there are challenges, obviously, with risk-reward.
What are some of those challenges? Because one of them, I imagine, must be liquidity. So it's all very well putting your money into those countries, into bonds or equities or the likes, but when you need to get it back out, how easy is that?
Accessing the markets and liquidity is basically the key determinant that faces investors in terms of challenges. If you look on the listed Africa equity side and you look at the largest markets, Egypt usually trades about $80 million a day, Nigeria $20 million a day, Kenya $4 to 5, and Ghana $500,000. And you compare that to South Africa, who's trading $1 billion. So it is a little bit less liquid. The reason for the liquidity, a lot of the multinationals have got strategic stakes in your African companies. If you look at the in-country fund managers, they've got very limited restraints in terms of alternate investments. So you find most of the pension fund money is locked and tied into the local markets on a buy and hold strategy. As soon as you see the capital markets flourishing, new IPOs coming to market, you should see the free float moving up and you should see liquidity picking up. But currently on liquidity, in sub-Saharan Africa, it's probably 8 to 12%. If you look at North Africa, Egypt, Morocco, Tunisia, it's about 20%. And then you're comparing that to South Africa at around 50%. We do expect that to pick up as the investment demand picks up over the coming years.
Are the rewards, though, commensurate with some of those risks that you are taking when you're investing further into the continent?
I beg your pardon?
Are the rewards commensurate with some of the risks that you're taking? I mean, is it worthwhile?
Yes. If you look at Egypt and Nigeria, the equity markets, they did underperform last year. Those are our top picks currently on the equity side. And we believe that the political risks in Egypt, for example, have been discounted into the share prices. It's off 25% year to date. Nigeria underperformed last year, but we do see those as our top picks. In Nigeria, the majority of the shareholdings on the index are the banks, and we see a very cheap and attractive PE valuation of 8.3 times, and that's on a forward PE basis till the end of the year. So we do believe that on a fundamentally based, bottom-up, stock-picking basis, there are opportunities, and the reward is worth the risk.
Well, Mark, you mentioned with just among 5 fund managers, there was over $1 billion invested in funds in Africa. To what extent are exchange controls holding back investment from South Africa into the continent?
There are exchange controls that are levied on your investment managers in South Africa. Currently, of retail assets, pension funds, retirement funds can invest 25% offshore. Unit trust, collective investment schemes, 35%. Above this, you've got an additional 5% of an African allowance, which is earmarked for investment into Africa. So aside from these dedicated equity funds, you've got your mainstream funds who are managing balanced portfolios who can invest in Africa. So the 5% Africa allowance is actually a benefit because this can only be deployed into Africa and not offshore. And in most cases, when there are IPOs or very exciting opportunities, you do find this additional 5% being deployed.
Mark, give us some of your top trading ideas. Where are the opportunities within the equity and bond space, and also in the cash space in Africa?
Yeah. Standard Bank proposes a cross-asset selling coverage model. So we do look across asset class. We've already mentioned on the equity side, we like Nigeria and Egypt. If you look on the currency side, there's a handful of hydrocarbon producer country currencies, and that's essentially the main revenues, your oil exports. These countries are sitting with surpluses on your current account. Balance of payments are looking good. They're high yielding currencies. We're talking about Nigeria, Egypt, Ghana, as well as Mozambique and Angola. They are heavily managed currencies, so the central bank does get involved in terms of keeping inflation in check. We do see value on these currencies, and we're looking for appreciation. If you look on the bond side, we like Ghana in the 3-year area on the curve. There was a 3-year auction two weeks ago, printed at 13%. If you go back 2 years, yields were about 25%. Foreigners like Ghana, they like the yield curve. We're recommending the 3-year. Apart from that, if you look into the international markets on the euro bond side, for the African euro bonds, we're neutral on Ghana, Nigeria, Gabon, and we like Ivory Coast and Cote d'Ivoire. So you do find across the asset class spectrum, there are very exciting opportunities in Africa.